Live from the Traders Expo in Chicago, Illinois, I'm Adrian Manns. I'm here with Boris Schlossberg. We are going to go back to my favorite topic of late, which is volatility. I've already bored everybody with the stories of how volatility is affecting my business. How about you? What's it like in your world right now?
Whatever it's doing to your business is doing 10 times worse to mine, because in FX, it's really the market that is most affected by this, what we call central bank financial repression, where central banks have pumped so much money into the market right now. We're at a point right now where trillion of sovereign debt is at negative rates. 3 trillion of corporate debt is trading. In Europe, we have junk bond corporates that are trading at negative rates. And that's creating such a slush fund of money and basically allowing market makers to buy the highs, sell the lows all day long. It's just creating such a tight ranges. To give you an idea of just how ridiculously tight the ranges have been, today, as we're doing this today, Eurodollar, which is the most active, the most traded pair in the world, actually is the most active financial instrument in the world, traded 18 pips. Imagine the Dow Jones Industrial Average trading 18 points on a daily range. That's how little volatility we're seeing right now. Part of it, of course, is just the summer doldrums, but regardless, even in the summer doldrums, this is not normal market action.
I was going to say, so first off, for people who aren't Forex traders, what would be a normal range?
So, a couple of years ago, a normal range was about 100 pips per day, 100 points per day. That's sort of like a standard, typical range in the euro. A couple of years before that, it was even 120. Lately, it's been about 70 to 75. That's sort of a normal range. Sometimes maybe we get down to 60. So this is more than 2/3 less. This is literally like 15% of normal range, which is just ridiculously low. And we've only seen these kind of actions on holidays, on Thanksgiving Thursday when nobody's around. So the fact that we're at these very low ranges, I think suggests markets are incredibly complacent, very much in a kind of a complete stasis of equilibrium. And it's difficult to move prices. Nobody's really trying to move markets.
So now go back to what we were saying a second ago, though. How much of it is attributable to summertime trading? Because I know in my business, July, August.
Correct. So of course, Forex markets are the most international markets in the world, and of course, a huge part of them is driven in Europe, and a large part of it is driven in North America. And both of those places, everybody in July and August is either in Saint-Tropez or in the Hamptons. So there's clearly quite a little bit. But don't get fooled, because anytime we can get macro risk, and there's lots of macro risk right now. We have the Iranian situation really blowing up. We still have, I don't know if people are paying attention, but Hong Kong right now is becoming just an incredibly tense situation. There was a lot of violence, completely unexpected violence overnight, and you just never know when some of these things could just burst out in the open. I remember August being sometimes very volatile months. If anybody remember long-term capital, back in '99,
Absolutely.
That was one of the most volatile markets, times in the markets in years. So don't be too complacent about summertime, but I think it's the combination of summertime and so much central bank easing and the markets essentially completely in a complacent mode that has created this unnaturally tight ranges.
So how much of the Fed do you think is baked into the cake? Because when I'm looking at this, I think back to interviews that I did maybe a year ago for the Money Show, and we talk, and the commentary was along the lines of, well, yeah, they're going to raise, but they're only going to raise so that they can lower later because they need to have the tool at their disposal. Right. And this was sort of baked into the entire philosophy people had about the markets was the rate hikes aren't going to matter because a year down the road, we're going to the moon because the rates are coming back to zero. We're going to have negative interest rates. Right. What do you think?
Well, I think it's an accurate view. I mean, it certainly turned out to be an accurate view that whatever the Fed was trying to do to raise interest rates was really much more so they could have ammunition to then lower rates. But I think the other component here that people are struggling with is the absolute absence of inflation. And I was actually talking to somebody on the floor today that why do we have so little inflation?
Right.
And that's because I think people misunderstand what inflation is. People think inflation is a demand-based phenomenon. In other words, you give people money and people are going to spend money and that's going to create inflation. But that's really not how it's been working.
Right.
Inflation is much more a supply-side phenomenon, meaning that when you have constricted supply and things cost a lot more, that's when inflation really kicks in. We haven't had that at all. If you think about this, we haven't had shortages of anything, and whatever shortages we've had the technology to overcome those shortages very, very quickly. oil prices, the last time we had massive inflation was in the early 70s when we had a big oil shock, right? Oil went from like 18 to 30, which is equivalent to like 300 now, and that had massive impact all the way throughout the economy. We just don't have that now. As soon as oil goes up, frackers come in and bring in oil. Amazon is having just incredibly destructive aspect on prices because they're constantly bringing everything down to the lowest, common point. And I think those factors are just frustrating policymakers because we don't have any inflation, and it's very difficult, frankly, to imagine when we will have inflation, given the current economic and technical conditions.
Yeah, it seems like it's pretty hard for newer traders, especially now, to know like which economic numbers to pay attention to. I've got a bunch of people who refer to it as the Bureau of Economic Falsehoods when this stuff comes out, because they're just like, it's not gonna impact my trading at all. Why should I pay attention to it? And I'm like, well, that's very telling in and of itself, right?
Yes.
That the inputs are never fluctuating. Nothing's having any impact at all, it seems.
That couldn't even be more true in the Forex market, where we used to have news events used to have meaningful impact on. I mean, they were the primary drivers. Forex market is very news sensitive, and now it's nothing. You could have non-farm payrolls come out, and the euro will do, or dollar yen will do 20 points and then come back down and settle down, because news ultimately does not matter. The only thing that matters is money, and money is easy. And I guess until that trend changes, the single best trade in the market has been to just buy every dip that's been around. Now, that's going to work until it doesn't, and when it doesn't, I'm afraid it's going to be very, very nasty. But for now, really, it's very, very hard to fight that theme, which is you buy every dip that comes your way, because the central banks are going to rescue you for the time being.
Okay, and the name of your website again, if people want to follow you?
If people would like to follow us, I'm at www.bkforex.com. Please come take a look at us. I'd be happy to show you some of the Forex trading ideas. We have both signals and courses, and if you're interested in the market, I'd love to have you in our chat room.
All right, thank you. My guest, Boris Schlossberg. For the Traders Expo in Chicago, I'm Adrian Mans.